Keith Akada here again at the Mortgage Row with Fairway. I'm super excited to kick off my education series and very honored to have Lance Schaefer to join us from our FLS Appraisal Management Services. And just as an introduction to Lance, he is a Washingtonian, a native here, and a Washington State Coug graduate. I'm a Husky, so I got to give you a little bit there, Lance.
Yeah, I know.
He's a certified residential appraiser who has been practicing for over 20 years. He has been a staff appraiser and a review appraiser for a variety of banks and lenders for much of his career, focused primarily on reviewing files and trends of the western states, Hawaii, and Alaska. When he's not appraising, he enjoys hiking, skiing, and Seattle sports teams. So as you can see in his background, he just shared that he was up in Whistler, so you might catch him on the slopes if you're a avid snowboarder or skier. So Lance, it's great to have you. And, I'm gonna let you kick things off here and ask questions along the way to get everyone engaged.
Yeah, so thanks to Keith for inviting me today. We're going to hit some highlights on Fairway and Frisco Lender Services. I'm also going to give you some insight into a few appraisal items that hopefully will give you a better understanding why an appraisal is set up the way it is. And if you decide that you want to rebut an appraisal, what tends to work, what tends not to work, basically so you can focus your energies on arguments and rebuttal information in a way that's more likely to impact the results. And if you have any questions, you can put them in the chat, and Keith or I will do our best to answer them, because the point is to try and help you understand this process a little bit more. So I'll just kind of jump into it. So the first thing I kind of wanted to talk about, since I have been in a bunch of different mortgage lenders and banks, is that there's a very unique aspect to Fairway and Frisco Lender Services, or FLS, which is that we're a very horizontal company. And what I mean by that is, a lot of big banks, they're siloed. There's like lots of managers and middle managers and everything like that. And so when you try and get an answer, or you have an underwriting scenario, or you have a hard to place property, it can be tough to get a quick answer. And both FLS and Fairway, there's not a lot of middle managers. So if Keith has a question on an appraisal issue, or he's got an underwriting scenario on a tough property that folks are trying to find a place for, we can both reach out to decision makers and get real answers on whether it would fly, what would be needed, those kinds of things, so that you have that information on, is this going to be an easy deal, a hard deal, how to make it work, those kinds of things. And the real focus is responding very quickly and getting information in people's hands so they can make informed decisions. So. And also, the other part of that is if Keith or a branch have concerns about an appraiser, we do investigate those to see if there's something either from a customer service standpoint or a quality standpoint that we don't like. So it's another aspect of, like, if they have concerns, we can just really check into them and make sure we have a top-notch panel. So how is Frisco Lender Services different than most AMCs? So we have elite panels, and we really focus on manual order placement. So what does that mean? Well, many banks or AMCs use an automated order placement system. And it makes sense from a scales perspective when you think about thousands and thousands of appraisals. But where it doesn't make sense is if you're trying to close quickly or build relationships with appraisers that are willing to drop things and work on your file. So we have a team that manually places every order with an appraiser. This allows them to monitor the service of these individual appraisers, build that relationship over time. And if there's a real time crunch, like let's say you have a final inspection that needs to get done today, kind of a thing, on a super rush, because we built those relationships as opposed to just randomly kind of next guy up kind of a thing, we're more likely to get appraisers that are willing to kind of fit that in and deal with that emergency, or deal with a minor change in the assignment without throwing a big fuss, basically. To be on our elite panels, who are the folks that get the majority of our work, they have to basically agree to certain requirements on turn time and service, and they're constantly monitored. So the idea is we want to build these relationships with our best appraisers and give them the majority of the work, have them meet high standards, but also build that relationship so they can do little extra things for us that, somebody that you're giving one order to every several months is not going to do for us, kind of a thing.
Hey, Lance, I'm going to chime in there. Just as an example of the gratitude that I have as a loan officer on the street, if we go back to 2020 and through 2021, and much like 2022, when the market was very competitive, being able to close in 10 business days and having confidence as a loan officer that when our team submitted an order that it would get assigned, they would get the calls in, they would get it back, and it was always delivered as promised. So to you and your team, Lance, it's huge for me to have that confidence. Truly, I can say because of the appraisal process and the commitment and the accountability to hit the dates that were always stated, because my team goes as far as soon as we see the dates that it was scheduled for, we send out that notice, and it's always come through. So from a loan officer's perspective, that is huge to be able to have confidence to say we're going to close in 10 business days.
Yeah, and another part of that manual placement and that relationship with that team member and the appraiser is, they're checking, is the file going to come in today? Those kinds of things, and trying to get feedback for the loan team on, is there a problem? Are we on time? All those things that are going to be very important to you, managing your relationships and the closing date and all that kind of stuff. So, all right. So I wanted to kind of very quickly show you, the basic idea of an appraisal is we're trying to find a subject property. We're trying to figure out what it relates to. And in a perfect world, we're going to find something that's better than it, that everybody can kind of agree we are not that. And we're going to try and find something that's inferior where everybody can agree, well, we're better than that one. And then add additional sales to kind of whittle that down. So I'm just going to show a quick picture that I've used in previous presentations and stuff like that, that kind of talks to that. Oops. Please share screen. Can you see that, Keith, with the houses on there? Okay.
We're good.
All right, so here's just a quick dirty example of it. So if we're this top house, here, the appraiser might have, this is obviously for, extreme illustration purposes, but, we're obviously not as good as this mansion in the lower left. We're obviously better than this home that probably is a tear down on the far right with all the tagging on it. This middle home, are we better than it or worse than it? That would be what would be kind of refining what we're doing, but that's kind of the basic idea. What are we better than? What are we worse than? And then what do the other sales tell us about where exactly we should be? So, all right. So one of the other issues that comes up quite a bit, and again, if you have any questions, just throw them in the chat or contact Keith later and I'll get back to Keith. So dollars per square foot. So it comes up a lot in rebuttals and stuff like that. Super easy to calculate. It's on all these websites like, Redfin and Zillow and all those kind of things. Why it is not a great indicator in the single family residential appraisal market is because it really only looks at two things. It really only looks at the price and the GLA of the home. So it doesn't look at things like, great views. It doesn't look at things like bad locations, the quality of the house. So just calculating dollars per square foot and multiplying it by the GLA is not a real accurate way to kind of figure out the value of a property. For it to really work, you'd almost have to have like a community of like model match homes that are fairly new, where there's really no differences. And they're not old enough to have like deferred maintenance and stuff like that. And that's why the appraisal is kind of set up the way it is. It's trying to mimic buyer behavior, that behavior where you look at a house or look at multiple houses and you look at this house and you say, I like that kitchen. I probably pay a little bit more for that kitchen because it's brand new. But this other home we looked at, it needs some work. I would want a discount, before I dealt with it. That's the basic kind of idea behind it. So, Dollars per square foot really only comes into play in like commercial real estate, office space, and sometimes like custom one-off new construction, that kind of thing. So you're much better off submitting just additional sales that are similar than trying the dollar per square foot route. So, okay. I wanted to show you a little bit. A lot of questions come up on where the basement space is. So let me show you a quick thing on that so that you'll be able to tell where that space is. Okay, so this is an appraisal in Bellevue, Redmond area that we blacked out. And, 15 years ago, we could combine the GLA and basement space. We could kind of do it many different ways. And at some point, Fannie Mae decided that they wanted it all to be done in a certain way. And they basically came up with a system called UAD. Doesn't really matter. But anyway, if something is below grade, and what I mean by that is we're not just talking like a walk-up basement, where it's 4 walls around a basement kind of a thing that you'll see in Seattle. Anything where even like a couple inches is below grade. So if you think about like a tri-level, normally with that one level, one side of it is against the grade. So you go in the main level and then you go downstairs in the tri-level kind of a thing. That lower level has one level against the soil. That would be considered basement space. Like in a split level, most of the time it's going to get broken out into GLA and basement. I do know that there are some, split levels that are, it's just a design. It's all really above grade. But so if you look at the screen, you hear this highlighted part. This section here says gross living area. That's going to be everything above grade. And so when you're asking yourself, well, gosh, where's my extra 2 bedrooms? Just look down below it here. It says basement and finished rooms below grade. And so this is the amount of total square footage in the basement, 1118. And this is 1118 square foot finished walk out. So in other words, instead of a walk up, it's walk out. A lot of these abbreviations are in some of the boring pages of the appraisal, but that's what this particular one shows. And then all these abbreviations are the room count. So for example, on this one, it is 1 rec room, 2 bedrooms, 1.0 baths, so 1 full bath, and then 2 other rooms. Could be a den, rec room, whatever. So if you do have a home that may have a basement space, just remember there is this space below the GLA. And if you're looking for rooms and you see, okay, borrower saying that I have 2 extra bedrooms and you see that 2, that's where that extra 2 bedrooms are. So
Yeah, that comes up quite a bit. I've had a lot of times clients will go back to the real estate agents and ask, and I'm very thankful that the partnerships that I have, a lot of them are so veteran and seasoned. They understand all this, but I can't tell you how many times that comes up. And then the clients come back and say, your appraiser did this all wrong. And it always comes up when the value came back short. So it's really good to know this part just to be able to articulate it.
Yeah, and one other thing. So stuff like ADUs, arenas, any of those kinds of things beyond just like the core house are generally going to be at the bottom area. So below, I'm highlighting deck, test, porch, but they're generally going to be in one of these spaces below here. But the only thing they can put in the GLA is that main house and stuff that's above grade. So if you're looking for something that is detached or an ADU or arena or whatever, it's going to be down at this bottom part, probably below the decks and porches. So
I do have a question. You brought up a good point, because in our market here, hyperlocal lands, the DADUs or detached accessory dwelling units are coming up. If it has one and it shows up in that porch and patio area, is an appraiser required at any time to go back and look for permitting? Or is it they're just strictly there at what is visual, and then they're just appraising that subject property?
Well, that's a bit of a messy question. I'll do my best to answer it.
Yeah,
but,
sure.
so appraisers are not really code enforcement officers. And we try not to get into that realm because that's really not what we're trained for. And you're talking about reading all
Yep.
kinds of WACs and RCWs and local codes, and it gets super complicated. And then you
Yep.
throw in grandfathered status,
Yeah.
and you could spend days looking
Yep.
at this stuff. But, things we're looking at is, is it done to workmanlike condition? Is it possibly legal are some of the biggest things. So I make a distinction between not permitted, which
Mm-hmm.
by that I mean the zoning would allow it. They didn't go through the steps to do it.
Gotcha.
And illegal. So illegal to me would be it's never allowed in that zoning kind of a thing.
Mm-hmm.
That's a much bigger issue.
Yep.
Than somebody who just didn't go through the steps, but it's going to depend on the loan program and some of those elements.
Gotcha. No, just appreciate the touch on that.
Yep. Okay. I'm going to show you one other thing here because we're going to jump into like reconsiderations and rebuttals and what works. So here's a location map. And this one is kind of, Lake Sammamish, Redmond area kind of a thing. Let me zoom it out more. All right. So what I'm going to say in a second is if you want to rebut an appraisal and you're like, we think this value is too low. We don't think he took into account everything about it, that kind of thing. What I generally say is use the parameters that the appraiser used because you're really trying to submit something that is make the case that it's more similar than what the appraiser used. So in this case, if we're talking about location and you're doing a radius search or search for additional sales, in this case, the appraiser went out 2.98 miles. So I would say, I can't speak for every bank or lender, but, here at FLS and Fairway, if you sent us a property 2.98 miles or closer, we're going to give that more weight than if, say, you sent us something south of I-90 or, north of 520 or something like that. And then try and stay within those same neighborhood boundaries. So, if you send us something on the east side of the lake, we're not likely to send that to the appraiser because there's all kinds of compliance rules on what we can send, that kind of thing. But again, I would look at the location map. That's also where I find red flags. So if you're trying to determine if an appraisal is good or not, if you look at the location map and, for example, all comps are in one direction, that could be a red flag. Now this one, it's a little bit of a weird situation because it's kind of bound by Merrimore Park to the north. So there's not a lot of properties as you head up towards Merrimore, and there's a lot more condos and stuff like that. But those are a couple of things that you can kind of look for. So let's talk a little bit about more reconsiderations and what works and what doesn't, so you can kind of focus your energies and time on the things most likely to impact things. So the first question I get a lot is why do it? Like, do they ever work? Why would the appraiser change their mind or change their report? Those kinds of things. And I get that. It's frustrating. Most appraisers I talk to, they just want the best appraisal out there they can get. And there's weird reasons why sales won't come up. So some agent may have marketed to a certain zip code, or they may have marketed to a certain type of buyer. So it may not show up in their search for some weird reason, kind of a thing. But at the end of the day, are there curmudgeons out there? Yes, I deal with those curmudgeons. But for the most part, most appraisers, they don't want to get reported to the state. They don't want to get in a messy defense. So if you send them something that's truly relevant, and what we tell them is, we just want the best supportable report at the end of the day. So if that loan officer sends you a rebuttal and that sale is really relevant and it changes the value up, great. We want the best report at the end of the day where you don't have to buy back, which I'll get to in a second. So do they work? Yeah, it's about 25% of the time. Some of them are out there. As I talked about a little bit with the location map, so just expanding the radius doesn't really work. You really have to kind of work within the parameters the appraiser used in that little area. I would also say, in terms of using the appraiser's parameters, so how far back do you go for a sale? Again, I would look at the report. So I would say if they go back 6 months, anything within 6 months is fair game. If they go back a year, then go back a year. But if everything they have is like 3 months old, I wouldn't send like a year-old sale. It's not really likely to get used, kind of a thing. And we're looking at the pending date, so the off-market date. And the other thing is to really focus on objective arguments that can be verified. So for example, comments like a house feels dark, air quotes, or obviously inferior, stuff like that. It's not as helpful as stuff like the subject has a wall of windows that faces towards a territorial view, but the comparable only has a few small builder grade windows. That's something that I as an appraiser can see in a photo or report. Anybody can, looking it up, and say, yeah, there's a big difference there. Did they adjust? Did they not adjust? That kind of thing. Or for example, the subject has granite counters, but the comp one has laminate counters, and there's no condition or quality adjustment. It's another thing that we can all look at and clearly say, and the underwriters can clearly say, okay, there's obviously something there. Should there be an adjustment, kind of a thing.
Lance, I have a question that always comes up. If a property is limited to bedroom and bath count, so let's say there was one other sale that was a 3-bedroom, 2-bath, but no other sales, and there's another very close in proximity, a 4-bedroom, that's always come up as a hot point. Like how can that be used? And in a rebuttal situation, is that a good comparable that for me as a loan officer, if I'm listening to my partners, is that a good one to submit, and how would that be viewed?
You can. It kind of depends on how limited the comps are and how complex the property is. So the more complex the property is, the more leeway there is with stuff like that. If you're talking about like a very conforming area, like, I don't know, parts of Sammamish or something like that, where there should be lots of 3 bedrooms, that 4-bedroom might come into play. But, it just really depends on the situation. If we're talking about something like on acreage out in Enumclaw with limited comps and stuff like that, some of those parameters are part of the equation, but we got a lot of other things going on like acreage and barns and stuff like that, where that's maybe not as big of an issue to send something like that. So bedroom count things can impact the value. It's really market specific there, but it's not an automatic. So we hear a lot, this has one more bedroom, it's worth more money. Maybe. It's probably, there's a kind of a point of diminishing return. So a studio to 1-bedroom, there's generally a big jump in value. 1 to 2, again, maybe a little smaller jump. 2 to 3, 3 to 4, etc. Once you get to about 3 or 4 bedrooms, for the most part, you're talking about the layout and the size of the house. If they're the same GLA, and the only difference is the bedroom count, one buyer is going to like those larger rooms in that size. Another person is going to like more bedrooms because it fits for their family more. Mm-hmm. So it really kind of depends, but you can send it. It's just a matter of how limited the comps are and that particular situation.
Gotcha.
Lance, hi, it's Heidi Klansnick. Sorry, I couldn't unmute early on to, say thank you and welcome, and I appreciate being here. Hi. Hey, my background is I used to be a commercial appraiser back in the 80s, and I became very close to earning my MAI, but then, had babies and life got in the way. Yep. But I'm always curious to hear a residential appraiser's opinion on the hierarchy of importance when it comes to choosing your comps between style. Like if you have a Rambler as your subject, you make sure you have all Ramblers that you send in if you want to contest, or is it as simple things like Keith was talking about, bedroom count and square footage? But I had always been of the ilk that you better work first with the style of the home. You're not going to have the same buyer pool for a split level as you are for a Rambler, in my opinion. And then as that grouping gets wider and wider when it comes to multi-level homes. So anyway, I just would love to hear you speak about the importance of finding the correct style.
Yeah, I mean, that is an important issue. It's going to speak to something that I'm going to mention in a second with rebuttals from Fannie Mae. I mean, not rebuttals, repurchases from Fannie Mae and the stuff that they're hitting us with. Um, in general, I think you're going to want, if it's a ranch, rambler, whatever you want to call it, one story, you're going to want the majority of comps and the greatest weight to go on those types of properties. And depending on how homogeneous your market area is, you may need to pull like some 2 stories or 1.5 stories, kind of that kind of thing. Some markets there is a price differential for 1 story versus two stories. Some there aren't. It really kind of depends. We've seen some changes in our market as we moved to a little bit more of we're much more of a multi-generational market than Seattle was, 15 years ago. So some of the things that used to be like maxims and stayed, understood things have kind of morphed a little bit. But so I generally think there's kind of 2 categories. So there's kind of like 1 stories and 2 stories, kind of a similar kind of a feel, and people do have a preference for one or the other. The cost of a 1 story is always going to be more expensive per square foot, kind of a thing. And then you have like split levels and tri-levels and stuff like that. And, basement homes get into the mix too, but they're generally walk-up basements tend to be in the older parts of town or period homes and stuff like that. So generally, if you're dealing with a tri-level or split level, I would expect, those types of homes on the report. You maybe will see some 1 stories or 2 stories on a split level report, but not often unless it's just like really limited comp selection or it's a very, very specific market. There are some markets where the second you go outside the neighborhood boundary, it's just a different animal kind of a thing. So I hope I answered your question, but I would say that, 1 story and 2 stories compete. There are a subset of the market that just wants a 1 story. I definitely know that. I typically wouldn't put a split level or tri-level on a 1 story appraisal, but it does happen with limited comps. And then with, tri-levels and split levels, those buyers probably, again, a lot of them probably have a preference for one versus the other, but it's not unlikely to see those both on the same report. So did I answer your question?
Yes, that's helpful. Thank you very much.
Okay, great. Okay, so I want to talk briefly about, appraisals in a declining market and how that's impacting things. Then we're going to talk about some repurchase stuff and any questions that anybody has. So depending on what market area you're serving, some of them are more stable, some of them are declining a little bit or correcting. Generally, the way the Seattle market works is that, the homes more into the core employment are a little bit more stable. The ones further out with longer commute times are a little bit more volatile. But we have seen some issues with new construction where the build contract was signed a year ago, but the builder is now discounting current sales. And the problem we've run into with some of those is if the competition for the subject is now being offered for less than what they originally paid a year ago at that original contract, it can be a challenge to hit that contract price. It's not happening every day, but it's seeing, you didn't see that 2 years ago, and we are seeing more and more of that happen. So that's something to kind of think about. The other thing is, if you're rebutting a report and you want to do this reconsideration of value rebuttal, and part of your concern is market trends. So the market trends on the report are supposed to be segment specific. And what I mean by that is, when you pull up MLS stats on their webpage, they're generally either like all city or all county or an MLS area or school district or something like that. And they're not often split out to the type of home or the neighborhood. So if we're talking about all of Redmond single family, we're talking about stuff that's 7-year-old 1 stories versus things that are brand new waterfront view, $5 million properties, and they don't all track the same. So if you are rebutting something that has to do with market trends, the more you can kind of try and pull some data that's specific to that segment, like let's say your home is an entry-level home in Redmond, those are going to perform differently than those $5 million waterfront deals. And conversely, if you are dealing with a $5 million waterfront deal on the west side of Lake Sammamish, that's really where you need to pull your market trends from, not just, the lower price stuff, which tends to move much quicker and stuff like that. So,
Hey, Lance, I want to segue there really quick. City Mortgage, this just happened to one of my coworkers. City announced that they labeled Seattle and Bellevue as a declining market. So in this situation, the deal actually fell apart. They had to find another jumbo investor. And the main reason is because when City's way of rebutting that situation as a declining market, they required the borrower to bring an additional 5% in towards a down payment. So I just wanted to ask, have you heard of any other institutions on your side or run across that where you've started to hear that they're considering Seattle or certain parts of Seattle and King County as a declining market? Or it seemed like the unicorn to us, but now we're, of course, all super paranoid as loan officers when we're going into the jumbo sector, especially.
yeah, I mean, I think it depends on that particular lender and what resources they use. Fannie Mae has all this stuff behind the scenes. So they have all these programs that they have their own belief on what's happening in the market and stuff like that. We really just look at it market to market kind of a thing. Sorry, I lost my train of thought there. I was kind of trying to think of two things at once.
Oh no, just if there's any other, this came about on the jumbo side. So if there happen to be, it just feels like Citibank to us is the unicorn, but we're hoping none of the other larger investors on the jumbo side start to label it. And what's helpful here is I'll just explain this from a loan officer side is Fannie Mae and Freddie Mac still are the conforming side. And then for each jumbo investor, they do everything differently because each one of them has their own guidelines. And so in this specific situation, it's not all lenders. I didn't want to paint the wrong picture there. This one is just targeted towards City on the jumbo side where they said, no, we labeled Seattle as a declining market. And because that's their specific guideline, in this situation, the borrower had to bring an additional 5%. So don't want to cause
we really take it case by case. We don't really have any red lines or, we can't lend in this area or anything like that. It would really come back to what Fannie or Freddie, I guess, is asking of that underwriter, or if somehow they've got something coded in their system. But on the appraisal side, we're really looking down to that sub-market on what's happening. And thankfully, our market is okay. I mean, I also cover like territories like Boise and Caldwell, where it's rough right now. I mean, it's like one of the areas I think was 10% down in 6 months or something like that. It was pretty rough. So yeah, I think it is something that we have to think about. It is something that is concern to underwriters because of repurchases, which we'll get to in a second. But we really take it case by case. And, going back to that horizontal structure thing, if there's concerns, Keith can reach out to underwriters and get questions. I can reach out to, I'm regularly in contact with our top underwriters. I mean, where do you hear that? That doesn't happen very often, I can tell you.
Absolutely.
So, if Keith has a weird property and we're trying to figure out the eligibility of a property, highest and best use, whatever, I can reach out to our very top conventional underwriter and our very top FHA underwriter and get answers for Keith. So whether that's something weird with, highest and best use or market trends, whatever, I just really want to kind of hit that because I have been in these siloed mortgage lenders where you can't get straight answers, that everything here is set up for speed and getting answers. I think that helps Keith and everybody like move fast. So.
It's a huge win. I can't tell you from my 23 years of being on the broker side with two other direct lenders, many times where once that appraisal came back, you could submit it, but you just knew there was not going to be anyone that was going to help really challenge the situation and understand it, and at least hear us out of where we're trying to come back with an argument, but there's a lot here has been completely different for me. So again, to your
Yeah,
team,
and a
I
lot of what
appreciate
our staff appraisers try to do with rebuttals is also we try and put it into appraiser speak. So a lot of times we'll get something and people are obviously emotionally charged at times with their comments, and we'll take that and kind of put it into appraiser speak. So we stick to the facts and take out the anger. And, most of the time I understand what you're getting at. And so our staff appraisers can take that argument and put it into appraiser technical terms and stuff like that and kind of put a shine on it.
it. Sure. Appreciate it.
Okay. So one thing we also wanted to kind of touch on was a lot of folks don't know about what's going on in the repurchase world right now and how it's impacting underwriting. So we are getting more repurchase demands from Fannie Mae than we have in the past. And, if somebody's been in the industry for quite a while, repurchases like 15 years ago, 10 years ago even, it was more like you would look at that appraisal and be like, oh, wow, it needs to be reported to the state. This is garbage. I completely get, we missed it on this one, or the appraiser missed it. The stuff that we're getting now, it's a lot more spirit of the law stuff. So, all the guidelines that Fairway is required to follow with underwriting, they're very strict and specific. And the stuff we're getting now is you did not follow this particular guideline. So even if the value is accurate, you're still going to buy it back. So what does that do? It's going to be a few more questions from underwriting at times on certain things. And it's not to make your life difficult. It's not to make Keith's life more difficult. It's just the world that we're in with where Fannie Mae is at in terms of what kinds of loans they want. And I think a little bit of fear, that kind of thing. So one of the most costly elements for any lender is repurchases. So as we see more repurchases, those are going to influence how underwriting underwrites the file, the kind of questions that we get back and stuff like that. So the biggest thing that we've heard, I guess, to relay to you from Fannie Mae is they don't want us giving up location. And what I mean by that is, when we were really going hot and the market was overheated and things were selling in one day with 5 offers or 15 offers, the appraiser would sometimes go distant to try to address that recency of the sale. But the repurchases we were getting were saying, yeah, we get that, include some of those, but you can't ignore the home next door kind of a thing. Figure out the time adjustment, put it on there and adjust for time, but you cannot ignore the homes on the same street kind of a thing. So reports that you see going forward are going to be a mix, and we do get the comment of like, hey, this sale is 6 months old. Why are you using it? That's why. Is because Fannie Mae has basically come back to Fairway and said multiple times, because I see a big portion of these, do not ignore the sale on the same street kind of a thing. Adjust it by all means, like do the time adjustment, do the condition adjustments, whatever, but you can't just ignore it and jump across town, basically kind of a thing. So.
And to help everyone understand what a repurchase means and the significance of that to a mortgage company, you can imagine a mortgage company has to keep a certain amount of budget, let's just say their savings account, and they always have to have that to be able to function as a company. Well, as you can imagine, especially with the Seattle area or any high-end area, if Fannie Mae comes back and says with the new conforming loan limit, $977,500, a Fairway, you are out of scope. You have to buy this loan back. Well, how many loans can you sustain at that level before that starts to put an impact on your cash reserves, which now puts the company in jeopardy? So that's from a very high level, short description, but that's how serious it is in all of the mortgage world that are outside of banks. Because again, banks have their deposits from customer base. A mortgage company only is basically borrowing money to lend money in a way. So the cash reserves that they have, if all of a sudden they get hit with several repurchases, that can threaten a company to go out of business. So it is something right now that it's a hot button, and the loan officers are we're definitely on high alert that if you have a loan that's under repurchase consideration, it's a really big deal. So I just
Yeah,
wanted to help understand that.
sorry, I stepped on you there. I just wanted to add to that, um, we get 100 emails a day from some of our top executives talking about moving on a dime to the new market. So recently they've made some major changes that hit some of the news wires about reverse, and trying to make reverse quicker. Reverse has always been kind of a little bit of a pain point because of some of the things involved, that kind of thing. And, I just want to, I think that we're just very good at responding quickly. If you have questions about an appraisal, I think he's happy to help you, and he can reach out to me. The point in all this is to kind of help you understand why some of this happens the way it does. I think the more that helps you help your client, and we're happy to do what we can. So. Oh, I know what I was going to add. Sorry. A little bit tired this morning. But the other thing is, can your lender close loans? So, there was some big drama several months ago with a couple of the big banks out there and mortgage lenders where they were running out of cash. They could not, fund the loans that they had in the books. That is not Fairway's situation. Fairway's in great shape. Fairway's closing all kinds of loans quickly. And so if you have a question about, two companies, sorry to sound too much like an advertisement, but, if your question is like one of two loan officers and which platform to use, we have no problem closing loans. You will not have that worry here. There's obviously underwriting guidelines and stuff like that. But we are in great shape, and we are moving forward to, expand. And I think we're a great company to associate with. So
Appreciate that, Lance.
I guess any other questions?
No, I think that was it for us. Is there any questions that you, Heidi and Robert, that you might have from the field that you want to throw at Lance? I think the biggest point of this is just trying to prepare for what we've seen here when Lance thinks about the last 6 months, if that's the scope. And I feel strongly that what comes up here, you'll continue to hear me say this because I'm hearing it from the gurus, March 14th and May 10th, because that shows that inflation's coming down. And in turn, that's going to help pressure rates lower. We've already seen it here, Lance, just within Seattle in the last 3 weeks. When rates were in the low sixes, we went right back to multiple offers. Definitely there was escalation clauses again. I had a client who the only reason that they didn't win is because the offer waived the appraisal contingency. And, this was only our second offer. And they're like, Keith, that's over. That scares us. But just because the rates came down, it brought the buyers back. Right now rates ticked up, so that activity has definitely cooled a bit. But as we move forward into this year, the interest rates move lower. It's very a clear indication that more buyers can come back. There's still a inventory challenge. So with higher values and with the limited comps, that's really why I wanted to get ahead, and thank you for being here to host this, because it's a huge thing to consider that for sure in 2020 and 2021, thankfully I didn't have that many challenges. I looked at my total production in 2020. I had 3 challenges. In 2021, I had 2. And of those, 2 of them vividly, I can recall the only argument was price per square foot. And no matter what we did and no matter how I tried to put it together, it came back, the comps aren't good comparables. We're going to stand by the appraiser's opinion of value, and the price per square foot was always the argument. So it's huge to have you articulate this for us and help us understand. But the main intention here is because I do feel we're going to be in this market where prices are going to escalate faster than where the comps are. That's the biggest thing of understanding what are the fundamentals and what we can do to best support each other as we go into a time if we have challenges that come up.
Yeah, I mean, our market has always been seasonal.
Oh, you went on
and
mute there, Lance.
I am. Can you hear me?
Oh, oh, that's me actually. Sorry.
I can hear Lance.
Okay.
Sorry, that was me. I'm sorry. It's
Technology. Yeah, I mean, we've always been a seasonal market. So, generally, when the sun comes out, the buyers come out. And so I'm optimistic. I don't know any specific stats. I think Keith has looked into that a little bit more than I have. But I'm hopeful that, as the sun comes out, we'll have similar trends to previous years where people start poking their head out and thinking about where they want to be this summer. And, hopefully it'll be good.
Yeah. Heidi, Robert, anything? I'll take you guys, ask you guys to mute here, but if there's anything that you guys have questions on, please feel free to ask.
No, this has been very interesting. I'm recently been faced with a challenge, though, for a home which I've been asked to list, but the assessed value was increased 40%. And the comps, though, on my side to come up with the optimum list price are lower than the assessed value now. So it's going to be an interesting year. Now we have that to face as realtors, but I know I keep telling them that's not something to put your money on. It's definitely, we need to find the sales and then maybe do a little trending, but at the same time, it's going to be that's one other issue with so many assessed values going up so far up over the year over year.
Yeah, they always kind of tend to lag. And, by state law, they're presumed to be correct. So, it can be a battle to kind of get it back down. But, I mean, you just need data. There's data out there. But, yeah, I mean, because a lot of borrowers look at that and don't necessarily understand how mass appraisal works and how, they may not drive by the home every 5 years or something like that. It is an interesting metric. It is something we look at. But, yeah, like to your point, it's what's sold in that market. And, it'll be interesting to see how it plays out. So.
Well, I appreciate you being here, Lance. I know I'm going to get this out as a recording. I have notes, so I'll definitely include the notes when I send this out. Heidi, Robert, thank you so much for joining. And again, this is something that I made a commitment to for 2023 is to provide a lot more education on the hot topics. So Lance, I can't tell you enough how much I appreciate you being here and also the support in my 5 years with Fairway. The rebuttals that I have gone in that had the good comps I was successful with. And that's a huge win because the previous company I will not name, it's not professional. Once it came in, that's all I got. And it didn't matter what I did. So for me to have that confidence to help support my partnerships and the clients to come to a good outcome is huge. And so I really, really thank you and all of the team.
Yeah, well, thank you for letting me be there. And if you have any questions, reach out to Keith. He can get a hold of me if he needs to. And hope it helped. So,
all right. Thank you so much. Take care, everyone.